Hedge funds have absolutely been losing compared to the S&P 500 in 2021. That's right. All of those smart geniuses, all those people calculating all the numbers on Wall Street, they lost. The S&P 500 outperforming majority of hedge funds. What do I mean? The S&P 500 has returned 29% this year. Massive move for the S&P compared to historical numbers. Only 3 hedge funds of the major hedge funds actually beat the S&P 500. If we go ahead and we look at the list itself, these are some of the best hedge funds in the world. Go ahead and look at it. We've got Senvest, we've got Third Point, we've got Citadel, we've got D1 Capital, we've got 2 Sigma, 0.72, Renaissance, all of them, Tiger Global, Bridgewater, Brevin Howard, Element, Roku's, Melvin Capital. I mean, Melvin Capital lost 41% this year. Whoa. And so if you go ahead and you look at this, the S&P 500 outperformed everybody but 3 hedge funds on this list. Now, if we go and we look at actual hedge funds themselves, there's about $4.5 trillion in hedge fund AUM. Now, if you do a very simple calculation, they get paid 2 and 20 on most of these hedge funds. That is a hell of a lot of money. Now, if you are paying them, you expect outperformance. You don't expect them to lose to the S&P 500. You could obviously go and simply just buy a low-cost index of the S&P 500 if it's going to outperform the hedge funds. But in good times, like we saw in 2021, where there was 70 times that the S&P 500 hit an all-time high, it's really hard to outperform. Basically, if you're just long, you're going to get 29%. The hedge funds then have to time markets. They have to go in and out. They got to be short. They've got to hedge in case there's a drawdown. And so naturally, they're going to lag in bull markets. Where the hedge funds really outperform is when they're able to avoid catastrophe if there are market crashes. And so seeing this is not necessarily surprising, but it means that if you are an investor in these funds, without even accounting for the fees, you still did not outperform the S&P 500. Is this a argument as to why people shouldn't invest in hedge funds, or is this what we should expect in a bull market like this, where it basically just goes up all year? And so naturally, because of fees and because they're actually hedging, we're going to get some underperformance of the S&P.
I mean, there's a lot of evidence pointing that you're better off just doing broad-based index funds and stuff like that. If you just want broad exposure to the market, like you could just buy the S&P and you obviously would have outperformed 90% of these people. So when you take funds and when you take fees into account and everything like that, a lot of the times when the market rips like this, you're much better off buying the index. The question becomes like, if you want to do more exotic products, if you want to look outside of just equities, if you want exposure to other industries, if the market doesn't explode, right? If it goes down, if we see an 08 or 09 or something like that. And granted, the returns aren't always this kind of disproportionate, but ultimately, a lot of the time, you're just way better off buying the S&P or an ETF or an index fund of some type that's more broad-based and you don't have to pay fees on, or not as high as fees.
Joe, what do you think?
A lot of hedge funds made money this year. A lot of hedge funds also lost money this year, right? S&P returned 29%, and these hedge funds got paid on a 2% fee of $4.5 trillion. They got paid $90 billion to manage your money.
90 billion, and most of them didn't outperform.
I don't use a hedge fund. I think some people it's good if you don't have the time or the energy, but if you want broad-based exposure to the market, you can just do that yourself.
Bro, I'm laughing because you just hit them with the, I don't use a hedge fund. I thought you were going to follow up with, I am the hedge fund. That was like a little lion move there.
Essentially, I paid myself the management fee this year.
You charge yourself 2 and 20?
Yeah.
And outperformed them.
And outperformed
Damn,
them.
you should hit him with a 3 and 30 if you're going to pay yourself.
Hey, 2020 year was a good year for my portfolio.
What we should do is just measure
Bitcoin.
Bitcoin's return over the last decade versus the average hedge fund return, because I'm sure it's not even in the same stratosphere.
It's not even close. Not even close. The other piece of this too, I think, is that most of these hedge funds, one of the things that I always ask people is how much of the hedge fund manager actually has their own net worth or their own portfolio invested in their own hedge fund. Yeah. So there's, especially in the older days, like, a decade or two ago, there's a lot of hedge fund managers like, look, I'm managing my own money. You can invest alongside me. And this is 80, 90% of my portfolio. There's some private equity or maybe some real estate or something outside of our hedge fund. But for the most part, this is how I invest my money. And I have just as much skin in the game, if not more on a percentage basis than you do. Now there's not so much, right? Some of it's just mega funds. So you get people who are raising billions and billions of dollars, but also on top of that, you get just the management fees are so damn high that they end up actually having the ability to not put as much money in themselves. And so it just changes the way that the game's played. But ultimately, the market's just manipulated. They're going to continue to push asset prices higher. And so a hedge fund, meaning that it's hedged, it's going to lag out and not outperform in a bull market. And that's what we're seeing happen over this year.
Yeah, I also think it's important. Like they're not, all these hedge funds aren't necessarily pegged to the S&P and are trying to beat the S&P, right? So it's kind of unfair in some instance to claim that, you know, every single fund was out there trying to beat the S&P. That's not what they're there for, right? But I think a lot of the time when you just think about the hedge funds in general, a lot of them are optimizing just for management fees, right? And how much money can we get in here? How much money can we not lose, right? And give a rate of return that is equal or greater to than what people are expecting. So they keep their money in, you continue to get your management fee, and your business continues to grow with assets under management. So I think ultimately, like, it depends on what you're optimizing for. If you're an older individual looking for exposure to a bunch of different assets, compound your capital over time, and you don't mind paying that fee, sure, go ahead. But I think for a lot of younger people, like, they're going to opt out of this structure because there's so many different options now, not only with digital assets like Bitcoin and others, but also just index funds and all this other stuff that's out there. There's so many different options that you can go park your money into where you won't get charged these fees. And these fees, when you look at it over time, like, I don't have any charts here, but if you look at, if you just Google like what these fees do to your total return, it eats away at it over time. So I think a lot of people are waking up to the idea that not only are they underperforming in bull markets that we've seen in the last few years, but ultimately the fees that people are being charged are eating away at their total return.